Good day, great work learners. My name is Mr. Simbi, and welcome to an accounting lesson. This lesson is brought to you by the Gauteng Department of Education in collaboration with Sabono Discovery Center. It is always a joy, and I'm happy and excited to have you in my class today. And I know that you are also excited to be here. I want you to tell your friends to tell their friends that the class is on. So you need to tell your friends that Mr. Simbi is on. And today is a new topic that is going to be dealing with. And today I'm going to be looking at inventory valuation. So if you are having challenges with inventory valuation, it is very important that you tell your friends that class is on and they must tune in so that they can get help. Once again, welcome to today's lesson. Here are my objectives for today's lesson. Very simple and very clear. I'm going to look at four things. Number one, I'm going to look at inventory systems. You did this in grade 11, so I'm going to remind you again of our inventory systems. And then I'm going to look at the inventory valuation methods. Now, this is something new for grade 12, and I'm going to talk to the three methods that we have in our syllabus. And then I'm going to do inventory calculations or calculations that pertain to our inventory. I'm going to do them today. And then we'll also look at internal control questions and the possible answers that we can also have. Now, in grade 11, you did what were known as inventory systems. You remember that? All right. So in grade 11, we have the two inventory systems, that is the periodic and the perpetual inventory system. All right. Now, what are these ones? Let us begin with the perpetual inventory system. So the word perpetual or to perpetuate simply means to do something continuously. If something is perpetuating, it means it is happening continuously. That is over and over again. That is perpetual. So this system calculates cost of sales for each sale transaction. So with every movement of stock, this system calculates cost of sales. And it also ensures that there is precise and constant update on our inventory balances. With the perpetual inventory system, it is most suitable for businesses dealing with high value items. Running the system is very costly, very expensive, and it requires advanced sales software. So you see, these may be part of their advantages and disadvantages, but we basically we're talking about the characteristics. What is this perpetual inventory system? All right, then I'm going to talk about the next inventory system, which is the periodic inventory system. Now, with the periodic inventory system, our cost of sales is only calculated at the end of the financial year. So remember what we said with the perpetual. With the perpetual, cost of sales is calculated continuously. All right. But with the periodic inventory system, cost of sales is calculated at the end of the financial year. And the movement of trading stock, the movement of stock, is recorded in the purchases account. The business must conduct what we call physical stock counts to determine the stock value. And this system is commonly used by businesses selling low value goods in bulk. And now we're going to differentiate between the perpetual and the periodic. Okay, so I'm going to have my two methods here. Now, with the perpetual, cost of sales is calculated and recorded on every sales transaction. Remember, I said that earlier on. With the perpetual, with every sale transaction, we calculate cost of sales. Yet, with the periodic inventory system, cost of sales is only calculated at the end of the year. So the cost of sales is not prepared throughout the year, but it is calculated at the end of the period. So that is the one main distinction. Let's go to the other one. That with the perpetual, regular stock counts, which promotes better internal control and identification of trading stock deficits. So with this system, there is constant count of stock. Yet with your periodic, stock counts are only done at the end of the period in order to determine the value of closing stock. So here it is only at the end of the period, but here stock counts are done throughout. Then with the perpetual, the movement of stock is recorded in the trading stock account. Very key. Yet with the periodic, the buying of stock is recorded in the purchases account, which is an expense. Yet here, the trading stock account is an asset. Then lastly, when we transport our goods from where we purchase them to the business, the cost of transporting these goods is recorded in the trading stock account, that is with the perpetual. But with the periodic, the cost of transporting these goods is recorded in the carriage on purchases account. So you have these two different accounts. And then the accounts that will be used, as I said earlier on, with the perpetual inventory system, you have what we call a trading stock account. But with the periodic inventory system, you have what we call a purchases account. Okay. And then I'm now going to come to our inventory valuation methods. Inventory valuation methods. What was I talking about earlier on? Inventory systems. Inventory systems, perpetual, periodic. Now I'm going to come to the inventory valuation methods. And we have three methods, namely FIFO, that is the first one, the first in, first out. Secondly, the weighted average. And then lastly, our specific identification. And I'm going to do these three methods, and then we're going to see how it's going to go about. Okay, so as I said earlier on, we have the first in, first out, then we have the weighted average, and then we have our specific identification method. Let's begin first with our weighted average method. Now, with the weighted average method, it is used when stock of low value is bought in huge quantities. That is with the weighted average. It is used on products that are difficult to trace the cost of each item. The average price gives a good composite picture of the cost of the goods. And with a weighted average at the end of the year, the average price will be used to calculate the value of closing stock. And then check the retailer, or it is a retailer who sells pots and pans. Like here I'm saying, look at what I'm going to show you now. Okay, so this is a retailer who sells pots and pans. So they would use the weighted average method. The weighted average method is suited for stock bought in huge quantities. So here we are saying the term weighted means that the quantity of trading stock is taken into account, not just the cost price. So this is what I wanted to draw your attention to here. All right. Now, how do you calculate your weighted average? So there's a method which I'm going to give you now. There's a method which I'm going to give you now. And the method is you're going to have your rands at the top and you have your units at the bottom here. And then here is a division. And then you're going to say opening stock, all right, in rands, and then you have opening stock in units at the bottom. Then it's purchases in rands, and then you have purchases in units. You have returns in rands, and you have returns in units. Then you add your carriage together with your customs duty. And then remember to deduct your donations and drawings, okay? And then we will now say the answer is unit cost for each item, and then you multiply that by the number of units on hand to give you the value of closing stock. Now, for that to make sense, we're going to do our first calculation. And our first calculation is going to come from the Eastern Cape Prelim for the year 2023. And as I always say, a worksheet was sent to your school this morning. So the worksheet is available where you can see this particular worksheet, and then you have the information. And then when I do calculations here, you are able to follow through and do it together with me. So if you have the worksheet, then you need to listen as I do the calculations with you. So let us begin. The question reads, Lion Stores. The business owned by Lion sells one type of leather purse. The business uses the weighted average method. The business uses the weighted average method and the periodic stock system to value stock. Required. Calculate the following for the financial year ended 20th February 2023, the value of closing stock. So we're going to calculate the value of closing stock. And which method are we using? The weighted average method. So we come here then. And remember, that was our question. So to make it easy, I have this line here. All right. So I'm going to have my rands at the top and my units at the bottom. Okay. So in your book, just draw a line with the ruler. Just draw a straight line with the ruler. And then at the top, we're going to put our rands. And then at the bottom, we're going to put our units. Okay. So let's begin with the rands. We start with opening stock. Here is my opening stock, 71,040. So I'm going to come here. I'm going to say opening stock is 71,040 in rands. How many units were these? This was 480 units. So it's opening stock plus opening stock plus. Then we're going to come and add our purchases. You will see that we had a number of purchases. We purchased in May, in August, in October, and in January. So I'm going to take my total purchases here, which is going to be 362,500. So I'm going to come and say plus 362,500. That is my purchases. And in units, these purchases are 2,000. And here it's going to be 2,000, like that. So I have my opening stock plus my purchases. And then I'm going to come and say minus my returns. Minus my returns. So I'm going to come and say minus 6,150 minus my returns. So here's the returns in rands, and we have the returns in units over here. Then I'll say minus 30. That is in units. And then the next one that I'm going to bring is my carriage over here. Then I'll say plus carriage. Total carriage of 20,960 was paid for purchases during the year. Lion Stores were not reimbursed for carriage on the returns. So we're going to come and add our carriage here. And our carriage is how much? 20,000 plus 20,960. So let's solve the top part. So let's have our calculator. Let's see if our adding machine is working. We're going to say 71,040, all right, plus 362,500. That one there, minus 6,150, plus 20,960. It gives me 448,350. So I'm going to come in, I'm going to get 448,350. Then I divide that by 480 plus 2,000 minus 30. Let's go and see. It's going to be 480 plus 2,000 minus 30. That will give me 2,450. 2,450. Then I'm going to divide these two figures now. So I'm going to say 448,350 divided by the 2,450. Then I'm going to say 448,350 divide by the 2,450. And that is going to give me 183. So here I have 183. That is the weighted average cost per unit. All right, so that is the weighted average cost per unit. And how many units do we have at the end of the year? 360. So you multiply this by 360 and then you get your value. So I'm going to say now 183 multiply by 360 and you end up with 65,880. 65,880. That becomes the final answer. It is very important. You find that certain examiners would only want to test you on this 183 only. So you have to know how to get the average price per unit. Because I've seen some past papers where they only test this and nothing beyond this. So you have to know what is it that I am being asked to calculate. And when you get that, then you multiply by the number of units. And then you get your 65,880. Okay, and then I'm going to go on to the next one. So here we have our value of closing stock. Okay, after the value of closing stock, we're going to calculate what we call cost of sales. Cost of sales. So here's what I want to do. I want to show you a long way of doing this. Then I'm going to show you a quicker way how to quickly cut corners. Are you ready? Okay, let's do this together. So you know how to calculate cost of sales. You remember the business is using the periodic inventory system. That means we're going to come and we're going to say opening stock, and my opening stock is 71,040. And I'm going to come and say plus purchases, and my purchases is 362,500. Then I subtract my returns, which is 6,150. Then I close my bracket. And then I'm going to come here and I'm going to say 362,500. 362,500 minus 6,150. And then I'm going to get 356,350. 356,350. Let's confirm that figure again. 356,350. Okay, opening stock plus purchases minus returns. Then I'm going to say plus carriage. Okay, remember I said I'm going to show you something and then I'm going to show you the shorter way. Then we're going to add our carriage, which is 20,960. 20,960. Now let's add these figures here. So if we add these figures, we are now saying 71,040. 71,040 plus 356, 350. 356, 350 plus 20,960. 20,960. And that is going to give us 448,350. Did you see that figure anywhere? Yes, we had this figure earlier on, 448,350. Where did we have this figure? We had this figure here, 448,350. So it means after I had calculated this figure here, when I come here, I was not supposed really to redo this one again. I was just supposed to come to my 448,350. Then I simply say minus closing stock. Minus closing stock. You still remember the closing stock? 65,880. So I simply do that. I subtract 65,880. Then I come here. Then I'll now say 448,350 minus 65,880. And then I'm going to end up with 382,470. Okay. So I'm going to come here. So I'm going to end up with 382,470. 470. Okay. That becomes my figure. Let's do it again. All right. Let's punch it in again. Let's punch it again. Someone's saying, Mr. Simbi, I think you punched in a figure. All right. If we come back again here, yes, 448,350. So we are right. We are right. And then it gives us 382470. Okay, so that gives us our cost of sales. That gives us our cost of sales. Now, let's continue. Now, remember the cost of sales, 382470. 382470. Because here we're going to calculate gross profit. If you're calculating gross profit, you're simply saying your sales, which is your 2050 units multiplied by 295. So I'm going to get my calculator. It is my 2050, multiply that by my 295. And that is going to give me 604,750. Okay, then I'm going to come and say minus my cost of sales. Remember my cost of sales, we had it earlier on. There it is, 382470. All right, that is my 382470. And then we get the answer now. 604,750 minus 382470. 382470. And then I'll end up with 222,280. 222,280. That becomes the final answer then. At times, the examiner can ask you to calculate the markup percentage, so you must be able to do that one as well. Okay, so let's go to the next question. The next question then says, calculate the number of units missing. So you will find that certain examiners would bring different questions. Like in this case, we have units that have been stolen. Others would say the owner was giving units that belong to the business to relatives. So it's a number of scenarios that we end up having. Units are stolen, units are being taken by relatives or things like that. And we must be able to calculate these number of units at the end. So I'm going to show you one method, and then I'll show you again another quicker way. So the first one that I'm going to show you, I'm going to quickly open what I call a stock account. So I'm going to come here and I'm going to say this is a stock account. Here's a stock account. So on the debit, it's a plus, and on the credit, it's a minus. So in my stock account, I'm going to start with my balance brought down, my opening balance. Okay, remember this is my stock account and it's in units. It's my stock account in units. So I start with my balance brought down, which is 480. I come here, 480, balance brought down. Then I have my purchases. All right, I have my purchases. And my purchases are 2,000. So I have my 2,000 here, purchases. Then I'm going to bring my returns here because I want us to subtract them. So I'm going to say returns here. I'm just going to call them returns so that you can see them. Returns. How many units were returned? 30. 30 were returned. And how many units were sold? So I'm going to bring again my sales here. I'm just going to call it sales. All right. And how many units is that? 2,050. 2,050 for my sales. And then I'm going to have my closing stock. So I'm going to have my balance carried down, which is my closing stock. All right, that's my closing stock here. And my closing stock is 360. So I'm coming here and I'm going to say 360. And the difference then, the difference is the missing. The difference is the missing. So I'm going to say 480 plus 2,000. That is going to give you 2,480. So I'm going to come here. That is 2,480 here. Okay, the side with the highest amount. Then we're going to say now on our calculator, 2,480 minus 30 minus 2,050 minus 360. And then you're going to end up here with 40. So those 40 units is our missing units. The 40 units are the missing units. The 40 units are the missing units. Okay, now this is one way that you can do this. I've seen at times where you are not given the number of units here on closing stock. You can still use the same method to calculate those units. Someone is saying you do not have the balance brought down. Here's the balance brought down, 360 here. I'll still bring it. That is that one brought down there. Okay, here is another way in which we could have calculated our missing units. We could have said opening stock 480, opening stock 480, this one, plus purchases, plus my purchases, that is 2,000, plus my 2,000, which is purchases, opening stock plus purchases, minus returns, and the returns are 30, minus returns 30, minus the units sold, 2,050, minus the closing stock, because we still have it, all right, minus the 360, and that will give you your missing, which is 40 units missing. Now, you have to know that certain questions will be followed with your internal control measures. You have to have internal control measures that can be put in place. But these internal control measures have to be specific as to the kind of product. Okay, so you can have internal control measures for bicycles. That is going to be different for your cell phones. So you have to know the kind of product that you're dealing with in order for you to know the kind of internal control measures that you must then implement. Okay, so I think we have done quite a number of calculations with our weighted average. And whatever other calculations that are still missing, I'm going to do them with our FIFO method. So let's go on to the next type of method. Method number 2. Method number 2 is the first in, first out method. Okay, now with the first in, first out method, this is an inventory valuation method with an approach used to assign cost to every inventory item based on the order in which it was purchased. As you can see here, stock came in first, will go out first. According to the FIFO method, the oldest inventory items, that is those we acquired first, are to be sold first. So whatever we received first is what we sell first, while the most recent acquired items remain in inventory. So when we look at our inventory, we are definitely going to get the most recently acquired. The most recently purchased are the ones that are going to remain in inventory. And then retail businesses selling products such as clothing, electronics, or home goods and consumer goods often use the first in, first out method. This method aligns with the natural flow of merchandise, where older inventory items are typically sold before the newer ones. As you can see here, okay, so these are the products, and here we have our yogurt. We're looking at perishables, all right, that we need to sell those that came in first. We need to sell them first as well. Okay, so with the FIFO, the approach therefore is we sell the oldest inventory. Okay, with this method, it assumes that the oldest inventory, that is the one first in, will be sold first, and the newest inventory, the one we've just acquired, remains in stock. So how FIFO works is that when calculating cost of sales, we use the cost of the oldest stock when we calculate cost of sales. But when we are calculating closing stock, we use the cost of the most recent purchases. So we look at the most recent purchases. But to make this make sense, let's get a question that we can do together. Let's go and look at the NSE June for the year 2023. Remember, we're in paper 2. Okay, someone was saying, Mr. Simbi, where do we find these questions? Paper 2 questions. But you'd find that examiners can bring this in paper 1 and paper 2. Okay, so you can find a statement of comprehensive income with a FIFO question to it, or a statement of financial position with a weighted average question to it. It's very possible. And then you can normally find it in paper 2. That is where you find the more pronounced question. So here's our activity 2, which is adapted from the NSC June 2023. Are you guys ready? Okay, so if you're ready, let us then begin. The question reads, Mendy Jones. Mendy Jones. Mendy Jones is the owner of TV City that sells TV sets and has 2 branches or shops in KZN. The periodic stock system is used. No missing items were recorded for the financial year. So we know that in this question, there is no missing items. Then required. Calculate the value of closing stock of the active TV sets on 28 February using the first in, first out. Okay, let's go. Here's the set of information. So remember what we said. With the FIFO, we are working with the assumption, it works on the principle that stock bought in first will be the stock sold out first, which therefore means when we are looking at closing stock, we are looking at the stock that remains now. So the stock that remains is the most recent one. So when we are doing our FIFO valuation method, we focus on the bottom. So we're going to apply what we call the bottom up approach. So we start from the bottom and we go all the way up. We start from the bottom and we go all the way up. Okay, the bottom approach. For you to understand that, we are going to have our closing stock. So here is our opening stock, 280. And we're told that at the end of the year, we have 270 units on hand, closing stock. So I'm going to come here and I'm going to say 270. That is my closing stock. Then, one of the most important things is to consider the returns. Consider the returns. You have to consider the units returned. So the units returned are 60. And we are not told whether they are from January, September, August, or May. But we must be able to read that according to the information we're given. So I'm going to give you a second and look. Are these returns from January, from September? Is it August or is it May? You can see certainly that they are from January. Why? Because in January is when we have the cost price per unit of 4,100. So they are definitely from January. You're getting it now. Okay, so it means in January, I don't have 300 anymore because we returned 60 back to the supplier. So I come, I say 300 minus 60. How many do I have left? I remain with 240. So I'm going to come here at the top. I'm going to now say, if we have units that are left, it is of certainty that the units from January have not been sold. That is a certainty that the units from January have not been sold because we still have units left. And we know that whatever came in first was sold first. Therefore, whatever came in last will be the last ones to be sold. So if we still have some units, it means the last units purchased are those units of closing stock. So I'm going to come here and I'm going to look at my 240. So I'm going to say, in January, can I get the 270? No. How many units can I get in January? Only 240. So I'm going to come and say 240 over there. And then I say multiply. What is the cost price per unit in January? 4,100. What do we need now? The adding machine. Let's bring... Okay, there you are, my boy. 240, we multiply that by 4,100. You ready? Let's go. That gives you 984,000. That gives you 984,000 like that. 984,000 like that. And then we now say 270 minus 240. 270 minus 240. And then we end up with 30 units. Okay, so the 30 units, we then look in the month that is up. After January, we have September. After January, we have September. In September, can I get 30? Yes. What is their cost per unit? 4,000. I multiply this by 4,000. So I'm going to come and I'm going to say 30, multiply that by 4,000. That is going to give me 120,000 here. 120,000 over there. And then we're going to add all of this now. We're going to add all of that. How much does it become? It's 120,000 plus 984,000. 120,000 plus 984,000. That gives me 1,104,000. 1,104,000. 1,104,000. That is how I get the value of closing stock. What did I do? I looked at the most recent purchases. Remember, we are in February 2023. So our last purchases before we go to February were in January. If there's any units that are left in the business, it will be the units that we bought in last, which is January. So we went to January and we want to see, can we get 270? We could not get 270. We could only get 240. Why? Because 60 units were returned. And then we then said, if we can only get 240, we look at the month above January. That is the month of September. So we look at the month of September. In September, how many units do we need? We need only 30. So we come in, then we take our 30 from there by that. And then we get that. And then we are sorted. That is how we do our FIFO method. First in, first out. We look at the most recent purchases. Are you good? Okay, so this one was a simpler one. There's no carriage or anything like that. So I'm going to bring another one where I'm going to add carriage now. Can I do that? Okay, let's do one where I add carriage. So we're going to look at activity number 3 now. Activity number 3. This is from the NSC November 2022. NSC November 2022. Okay, so maybe before we do this, let's quickly take a 5-minute break, and then after the break, then we continue together. So I want to give you time to make sure that you do have this question paper. Look for the NSC November 2022. If you don't have it as a worksheet, please quickly download it, and in 5 minutes time, then we're going to do the question together. See you in 5 minutes. I'm back. Before the ad break, we did a question that was on FIFO, the first in, first out. And then we promised that after the break, we're going to do an activity from the NSC in November 2022. And that is what we have here. And I wanted to give you a chance to say, maybe you don't have the worksheet as yet. So you were to go and look for the worksheet so that you are able to do calculations together with us. So let's do it together then. Activity 3, Pitten Sports Shop. And it reads, Pitten Sports Shop is owned by Miroslav. The financial year ended on 28th February 2022, and then they sell powdered energy drinks, and these are 1 kilogram tubs. And then the periodic inventory system and the first in, first out stock valuation method is applicable. These items have a shelf life of 66 days. Required. Calculate the value of closing stock on 28th February 2022 using the first in, first out valuation method. And then we are given additional information as you can see here. Okay. Now, we have to understand one thing when it comes to FIFO, that before you do any calculations, you need to read all your information and understand it. When you have understood, especially the additional information, then you can do certain calculations. For example, here we are told the business pays MTY Transport a fixed rate of 8 Rand per tub to deliver to the store. So that is very key, very, very key. And then we have returns here, which is 30 damaged tubs. And then we have sales and cost of sales over there as well. Okay, so let's quickly come here. It says calculate the value of closing stock using the first in, first out valuation method. How many units is our closing stock? Our closing stock that we have is 235 here. So I'll come here at the bottom and I'm going to take my 235. I'm going to bring it here. 235. That is my number of units at the end. 235. Then we're told the business pays MTY Transport a fixed rate of 8 Rand per tub. That means I'm going to come here and say it's no longer 475 anymore because we're paying 8 Rand for the delivery to the store. So I'm going to say 475 plus 8. How much is that going to be? That gives you 483. Now it's 483. We do the same for November. 460 plus 8. That gives us 468. We do the same for April to September. 420 plus 8. That gives us 428 then. Okay, so we have dealt with adjustment number 1. Additional information number 2. Here we go. Returns to suppliers. Returns to suppliers. 30 damaged tubs from January. So remember in the other question we did not know. We had to look at the price. But here we are told now that 30 damaged tubs from the January purchases were returned to the supplier. The supplier reversed the total cost price paid, excluding the carriage on purchases. So it's the same as the one that we did earlier on. So I'm going to come and I'm going to say in January, 180 minus 30. 180 minus 30, that's going to leave me now with 150. So I end up with 150 over there. And then we come to sales and it reads 925 units were sold and the cost of sales amount to 404,140 after our adjustments were taken into account. So we are calculating the value of closing stock. So we know here is our foundation we're building, and then we want to get this one in rands. That's what we want to do. And we know that is 235 units, which is this one here. And then remember what we did earlier on. We start from the bottom and we go up. So in January, how many units can we get? Can we get the 235 in January? Certainly not. How many can we get? We can only get 150 because that is what is left after the return of 30. So I come here, then I say 150, like that. Then I say multiply. So it is my 150 units multiply by what? Here I have the cost of 483, which is 475 plus 8. So it's 483. 150 times 483. And then it is equal to, let's get our calculator. So it's going to be 150 multiplied by 483. That is going to give me 72,450. So I get 72,450. That becomes my value. We stay together. So what did I do? I started from the bottom, and then now I'm going up. And then I still need more units. Here I only have 235. I have 235, but so far I only have 150. So I'm going to come and say, all right, I'm going to say 235 minus 150. How many do I need? I need 85 units. So I look now, after January, I look in November now. So I'm going to come to November. How many units do I need in November? 85. So I come here, then I say 85. 85 from November. In November, what is the cost price per unit? 468. So it's by 468. 85 times 468. 85 times 468. And then that's going to give me 39,780. That gives me 39,780. Then I add these two amounts. Okay, so it's my 39,780 plus 72,450. So I'm going to come here, 39,780 plus 72,450. 72,450. And that's going to give me 112,230. 112,230. 112,230. And that becomes the value of my closing stock using the first in, first out. I look at the most recent purchases. You don't see me touch in September because I'm starting from the bottom and I am going up. Okay. So let's go on to the next one. The next one says, calculate the stock holding period in days. Use the closing stock figure. Calculate the stock holding period. You have to know that with inventory valuation, there are certain indicators that you have to calculate, certain financial indicators that you must calculate. You remember this from paper one, don't you? So here we are required to calculate what we call the stock holding period, and it must be in days. So I'm going to show you two methods. The first method is when I use rands, and in the next method, I'm going to use units. Okay, let's start with the rands. So if I'm calculating my stock holding period, one of the things that I have been saying in my entire lessons, know your formulas by heart. It has to be in the fingertips. So you have to know your formulas. You must master your formulas. Don't over-rely on the formula sheet. I know the formula sheet is provided, but do not over-rely on it. Know your formulas by heart. Are we together? Only when you have challenges, then you can refer to the formula sheet. But your formulas must be on your fingertips. So here we want to do the stock holding period. What is the formula? Anyway, here we're told to use the closing stock. So the formula is going to be your closing stock over your cost of sales. Closing stock over cost of sales times the number of days. Here we are told to calculate in days. No, that at times you can be asked to calculate in weeks, so you have to use 52, or you can be asked to calculate it in months, so you use 12. Then we multiply by 365 days here. Okay, let's go and do it together then. So we're going to say, how much is my closing stock? You remember, we calculated that, 112,230. So I'm coming here, I'm going to say 112,230. That is my closing stock. Over my cost of sales, which is 404,140. Then I multiply this by 365 days. I multiply that by 365 days. So let's come here. Let's see. I'm going to say, oh, we can just divide. It's fine. Okay, we're going to say 112,230. 112,230. All right, and then we divide that by 404,140. Okay, and then we get that. We multiply this now by 365 days. That gives me 101.36. Remember, we round off to 1 decimal point. 1 decimal point. So that's going to give me 101.4. So my answer here becomes 101.4 days. 101.4 days. That is my answer. And that was method number 1 when I use my rands. I'm going to give you method number 2 when I'm now using units. And when I do that, I'll now say my units at the end. Remember, closing stock. How many units is my closing stock? 235. So I'm coming here is 235. And then I'll say 235. I divide that by 235 divided by my cost of sales, number of units sold. Number of units sold, that is 925. Then I multiply this by 365 days. 365 days. Okay? And then let's come and see. So I'm saying 235 divided by 925. Multiply by 365 days. That's going to give me 92.7 days. 92.7 days. Both these answers are correct. This is correct, and that is correct as well. All right. You'll find that in most recent papers, in the papers of recent times, they have now changed that the answer that you get here would be the same answer that you get here. In other words, when you use your rands, you must get the same answer when you use your units. That is what I've noted in the most recent papers. But in the exam, you go there, knowing that you don't have time. So you have to find a method that is much faster for you, something that can give you the answer in quick time. Okay, we go on to the next calculation. All right. It says, calculate the average now. What was the difference here? Here, calculate the stock holding period in days using closing stock. So I tweaked the question. I changed the question, okay? If you go to the original question, it won't be like this. I played around with the question. So here now we're calculating the average. You can see there's a difference now because here we're just calculating the stock holding period in days, and we are told to use the closing stock. But here we are calculating the average stock holding period. Okay, so we're going to use the units method, the quicker method. So when it's average, what does that mean? We say opening stock plus closing stock divided by the cost of sales, number of units sold, 925, multiply by 365 days. Just like that. Okay? And then remember, average. So that has to be average. It has to be average. So let's do that together and see. It's going to be 130 plus 235 equals, divide by 2 equals. Okay, so we're going to get 182.5, 182.5. We divide that by 925, multiply by 365 days. Okay, so we come back here, then we say that divide by 925. We divide that by our 925, and then we multiply by 365 days, and that's going to give me 72 days. Okay, then it gives me 72 days. I just wanted to emphasize the aspect of the average stock holding period. That there's a difference. Here we're calculating the stock holding period and we're told to use the closing stock figure. But here is now the average stock holding period. So when it's average, you have to bring in the opening stock and the closing stock. You add the two, then you divide by 2 to get the average. And I have a third question in line with these questions now. And the third question then says, calculate how long in days it would take to sell the closing stock. How long in days it would take to sell the closing stock. So it is basically a question like this being asked differently, but let's see. If they say how long in days it would take to sell the closing stock, it means they're saying bring our closing stock. How many units is our closing stock? 235. And those 235 were sold in 365 days. Okay? Let me repeat that again. Let me do that again. Okay. So we want to find how many days is it going to take to sell the 235? How long in days it would take to sell the closing stock? The closing stock is 235 units. Okay. And then how many units did we sell this year? 925 units. 925 units were sold in 365 days. That is the right way to say it. 925 units were sold in 365 days. So you have 925, which was sold in 365 days. And then now you have 235 units. How many days is it going to take? So you're just going to use the UK method. You simply say what you want over what you have times what you have will give you what you want. Okay, so what you want in this case is 235. And what you have is 925. Multiply by 365 days. How long in days it will take to sell the closing stock? So it will be 235 divided by 925. All right, then you multiply by 365. And that's going to give you 92.7 days. So it's going to give you 92.7 days. It gives you 92.7 days. Okay? 92.7 days. Where did we see that earlier on? Here. So this question here, calculate the stock holding period in days using the closing stock figure, can be asked in this way. Calculate how long in days it will take to sell the closing stock. It's one and the same thing that can be asked in different ways. Okay, you got that one. Let's move on. Now we're going to come where we're going to comment on our calculations. And now we are told, comment on your findings above. Provide 2 points with figures. Note that the stock holding period for 2021 was 58 days. Okay, so remember our stock holding period that we calculated was our 101 or the 92 because we had two figures. Okay, so let's go. So you see our stock holding period for 2021 was 58 days, but the one that we calculated, we had two answers. We had 92.7 and we also had the 101.4 days. Okay, so what we can see is that the product is not selling well and stock is selling at a lower rate than last year. And we can also see that cash is tied up in stock. That is, our working capital is not being effectively used. And that the business is likely to have liquidity issues. And the product that we're selling now that is staying for about 92.7 days, this is a health product with a limited shelf life. When we began, we're told that the shelf life is 66 days. But now if it's taking 92.7 days, that means it will become perishable and will end up having to dispose it. Now, the stock holding period increased from 58 to 101 days, that is by 43.4 days. Okay, and then you can see that it is more days as compared to the shelf life. And if you use the 92.7 days, you see that it is increased by 34.7 days, which is more than 3 months on the shelves. Okay, so that is how you would have commented. But the examiner will bring such questions in different ways. It will bring them in different ways, very many different ways. After our first in, first out, we're going to come now to the third method for the day, which is our specific identification method. The specific identification method. Now, this method is used by businesses selling high value items, okay? And these items must be distinct. They must have distinct models and specifications that result in variable pricing, okay? For example, if you look at your jewelry or you look at your cars, where the price depends on the model and the engine size. Now, this method assigns a specific cost to an individual item or a set of identical items. Okay, now when we are using this method to determine cost of sales, the total of individual cost prices of all goods sold. So in order for us to determine the cost of sales, we take the total of individual cost prices for all the goods sold. And secondly, to determine the value of trading stock, we take the sum of all unsold items the business still has in stock. Okay, let's see if we can do this together. Have your calculation and the calculators ready then. Okay, let's begin. This is activity number 4 from the NSC May-June 2023. Now, before I begin this, I want you to grab your calculator. If you don't have this worksheet, you can also go and download this paper. I'm going to give you 2 minutes. So we're going to take a 2-minute break. And then after the 2 minutes, then we resume. Make sure that you use the 2 minutes. That if you do not have this paper, download it so that when I come back in 2 minutes, we can do the calculations together. And welcome back. Before the short break, we did inventory valuation question that was using the FIFO method. And now we have started a new method, which is the specific identification. And we did do speak to it. And I asked that if you do not have this particular question paper, that is the NSC May-June 2023, you can download it so that it becomes easy for us when we do our calculations. And then it says, so this is only an extract of the entire paper. I only took a section of the entire paper. And in the paper, there are different branches. And here we have the Durban branch. And in the Durban branch, this branch sells Pacific and Caspian smart TV sets. So you can see already these are specifically identified. You have your Pacific as well as your Caspian smart TV. Mandy was concerned about the following issues. The Caspian smart TV set would be too expensive for her customers. High stock levels in all her products might negatively affect the business. So you have 2 points here. And then Mandy expected to sell 1,000 Pacific TV sets in the 2023 financial year. She therefore adjusted the selling price of the Pacific TV sets in September and then asked the bookkeeper to provide an analysis of the quarterly sales. Okay. And then here is information about our TV sets. So we have the Pacific and we have the Caspian smart TV. And here is the demand. Calculate the value of closing stock of the Pacific TV on 28 February 2023 using the specific identification method. Okay, 4 marks. Now, this is something that we can get, something that we can grab. Now, you will see that with this method, you need to know how many units we have at the end. Okay, so we are told the cost price per TV is 9.3. That's the cost price per TV. And we have stock on the 1st of March. Stock on the 1st of March. And the stock on the 1st of March, that is the beginning. So stock at the beginning is 350. And we made purchases in May, in August, and in September. September, there was nothing. So we had 2 purchases here. And from those 2 purchases, our total units were 800. So it means at the beginning, I had 350 units. This is what I had at the beginning. Then I purchased 800 units. That therefore means I now say 350 plus 800. 350 plus 800. That gives me 1,150. So I had 1,150 units. And of those 1,150 units, we have sold 765 minus 765. We've sold 765 minus 765. And we are now left with 385 units. We are now left with 385 units. That is what we now have left, 385 units. Now, of those 385 units that we have left, we know that the cost per unit is 9,300. The cost per unit is 9,300. So we multiply them. We say 385 multiply by 9,300. And then we're going to get our 3,580,500. 3,580,500. 3,580,500. That becomes the value of closing stock. That becomes the value of closing stock. Okay. And then we go on to the next one then. Okay. So before I move on to the next one, this is considered one of the easiest methods. And as you can see, what we did here, we simply had to look at the units that we have at the end. And in order for us to do that, we said our opening stock plus our purchases. And then we simply subtracted our closing stock. Okay, our sales rather. Then we simply subtracted our sales. Then we ended up with our closing stock. And as we had our closing stock, which is 385, then we multiplied by the cost per unit. We multiplied it by the cost per unit, which is 9.3. And then we ended up with 3,580,500. And then the next question then says, calculate the gross profit earned on the sale of the new Caspian Smart TV. What is the gross profit on the sale of the new Caspian Smart TV? Okay, so there is a number of ways in which we could have done this. I'm going to show you two ways. So way number one, how to calculate the gross profit earned. We know that our sales is 10,934,400. That is our sales. And we are given the markup percentage here, which is 60%. Okay, so if I can take you back to grade 8 and 9, you know that you have your cost, and your cost is 100%. And you have your markup here now, which is 60%. And when you say cost plus markup, it gives you selling price, which is 160%. And that in rands is the 10,934,400, like that. So the question then is, calculate the gross profit. And we understand that our markup, that is our gross profit. That is the markup, the gross profit. So if we want to get the markup, we want the 60. That is what we want. We want the 60. And what we have is the 160. Multiply that by the 10,934,400. And we punch that on the calculator. So what we want is the 60. And what we have is the 160. And we multiply that by 10,934,400. 10,934,400. And that will give you 4,100,400. 4,100,400. That becomes your gross profit. This was one of the ways that you could have used to get your gross profit earned. Grade 8 way. Okay, grade 9 then. But you can see where we're coming from. A very easy way. Or we could have used a second method, which is B now. Can I use B? Okay, let's check out B. With B, we could have said, when I know that my cost is 100%, and my cost here is 10,200 in rands. I know that my gross profit, which is my markup, my gross profit, which is my markup, my gross profit, which is my markup, my profit, my markup, is 60%. How much is the gross profit in rands? That's what they're asking for. So I'll simply say what I want is my 60. And what I have is my 100. Then I multiply that by my 10,200. Come to me. So I'll then say, it is the 60 that I want over 100. Multiply that by 10,200. And that's going to give me 6,120. So I end up with 6,120. What is this? This is my gross profit, but per unit. That is the gross profit that I would make per unit. Then I'll say the 6,120, I multiply it now by the number of units that I sold, which is 670. So I multiply this by 670. So I'm going to come here and I'm going to say that multiply by 670. And that is going to give me the same figure again, 4,100,400. 4,100,400. That is what I still get. Okay, are we good? All right, beautiful. So we had two ways in which we would come back again to the same figure. Remember, guys, the exam is all about getting as many marks as possible. So it is the method that you apply that can get you the many marks. What I want you to do in June is to make sure that you practice effectively, that you can be able to attain as much marks as possible. Okay, so let's quickly go on now to the next question. And the next question says, comment on the quarterly sales of the Pacific TV sets and explain whether or not Mendy's adjustment of the selling price. So Mendy adjusted his selling price. All right. Whether Mendy's adjustment of the selling price. You can see here the selling price was 13.5 in May, March to May, and then June to August, still the same one. And then she adjusted the selling price downward from September to November, 10.3, and then 9.8 eventually. Okay, so we want to see whether or not Mendy's adjustment of the selling price was a wise decision or not. Quote figures or calculations. I'm going to give you exactly 2 minutes to do this one, and I'm going to see you in the next 2 minutes. So try this one on your own, then I see you in 2 minutes. Welcome back. Before the ad break, I showed you this question and I gave you time to look at it and see if you can attempt it. And the question read, comment on the quarterly sales of the Pacific TV sets and explain whether or not Mendy's adjustment of the selling price was a wise decision. All right. And then quote figures or calculations. So you can see that the reduction in the price did not achieve its objective. It was not a wise decision. Sales did not increase as expected. You can see here, the idea was to continuously decrease the selling price. It was decreased from 13.5 to 10.3, and then now finally from 10.3 to 9.8. The idea was that we can increase the units sold, but yet you can see the units sold keep on declining. So you can see that the reduction in price did not achieve its objective, that is to increase the number of units sold. It was not a wise decision. Sales did not increase as we had expected. So here our sales did not increase as we had anticipated. Units sold dropped. The units sold dropped from 245 to 160. So you can see here from 245 to 160. And they went all over to 110. That in the last 2 quarters. And then we can also say that the reduction in price means that she's barely covering cost, as the gross profit per unit declined from 4,200 to 1,000 and then 500. Okay, so you can see that if you measure with the cost, remember the cost for this TV is 9,300. That is the cost. 9.3. That is the cost. So if the cost is 9.3, so you can see that the profit declined. Here, the profit was 4.2, the difference between 13.5 and the 9.3. So here was making a profit of 4.2. And that profit declined because now the selling price is 10.3, yet the cost remained 9.3. So it declined over to 1,000. And then eventually, now since we're selling it at 9.3 and the cost is 9.8 rather, and the cost is 9.3, we're only making a profit of 500. So it was not a wise decision, as we see a continuous decline in profits. Can I move on to the next question then? Let's go. And then it says, comment on the stock holding periods of the Pacific and the Caspian TV sets. So you can see here, with the Pacific, it is 184 days. And with the Caspian, it is 71 days. What does that mean? With the Pacific, the stock holding period is 184 days. That is 6 months. This is too long. And once it is that long, it simply means our cash is tied up in stock. But if you look at the Caspian brand, it is 71 days, which is about 2.3 months. Therefore, this is acceptable. Unlike the Pacific, which is 6 months, which is not good. So this one will tie up our cash in stock. That is the Pacific. It will create cash flow or liquidity problems. It will create cash flow or liquidity challenges, unlike the Caspian, which is selling much faster. Okay, and then the next question then is, explain how the different holding periods affect the business financially. Okay, now it's coming back again to what I was saying. Let's start with the Pacific. With the Pacific, it is placing the business under strain. It creates cash flow problems, that is liquidity challenges. So it creates cash flow or liquidity problems. It creates liquidity problems. All right, because here we can see that the stock to the value of 3.6 million is on hand, and the slower rate of sales requires more investment in working capital. So when we sell our stock slowly, it will definitely affect our cash flow position. And if you look at the Caspian brand, it is selling very well. That is, they've sold about 340 and 330 units. So in total, that is in the 2 quarters. It appears that the investment in stock will be recouped in the near future. So you can see that whatever we are paying to purchase our stock, we are able to get that back much faster as compared to the Pacific, which is taking much longer, tying up our working capital. All right. Explain what these periods indicate about the preferences of customers, quote figures or calculations. As you can see, the number of units sold also speak to customers' preferences. All right, so customers are no longer interested in the Pacific TV, as you can see. All right, it may most likely be because it is old technology. All right, so the lower selling price in Q4 from 10.4 to 9.8, which is only gives 500 rand per unit. Okay, so you can see that even though we decreased the selling price, still customers did not come to buy. It could be because of the technology. So reducing selling price still did not assist us. But if you look now at the Caspian TV, that is the newer model, it is a bit expensive, all right, which is selling at 16,320. Now, the customers are prepared to pay even double what they are paying for the Pacific TV. So you will then see that customers' preference is on the Caspian TV, even though it is a bit more expensive than the Pacific. All right. And then the last question for the day reads, provide 2 points of advice to Mandy on how she can rectify the high stock levels of some of her products without reducing prices offered to customers any further. Okay. So what she can do, she can take some of these TVs to the other branches, um, and they can sell them in those other branches. Or she can extend the target market by exploring other areas where they may be sold. So you can extend the target market. Don't only focus in the area, but you can extend onto other areas as well. And what she can also do is to sell them in bulk to other retailers, or she can introduce online selling as well. Or she can donate them as part of corporate social responsibility. Then the company will benefit on its tax. And she can do more advertising, okay, more aggressive advertising, and change the medium of advertising as well. My good friends, we've come to the end of today's lesson, and I look forward to seeing you next week on the 23rd of May. Friday, I'll be here waiting for you. And I'm going to be doing tangible assets. I hear someone saying, thank you, Mr. Simbi. Yes, I'm going to be focusing on tangible assets. I'm going to be calculating depreciation. I'm going to be doing the R1 residual value. I'm going to look into problem solving. So if you have a problem with tangible assets, let's make a date. Next week, Friday, at 2:30, I'll be here waiting for you to tune in. Please do tell a friend to tell a friend that Mr. Simbi will be dealing with fixed tangible assets or calculations that pertain to fixed assets. I'll explore them and do them next week, Friday. Until then, enjoy your studies and goodbye.